Three stocks for September 2020. That's what we're going to be talking about on today's video. I have two growth stocks for you guys and one dividend play. Let's get right into it. Welcome back to the Fire Grind. My name is Daniel, and on this channel we talk about personal finance with a focus in the stock market. So as I mentioned today, we're going to be talking about three different stocks for September 2020, and the first one is Dye & Durham. The reason why I got into Dye & Durham stock is because looking at all the technology stocks on the TSX, typically they're a little bit flat in the beginning besides their first day pop, and then later on, a couple months down the road, they usually have some sort of large spike. And I think the reason is because when the company ends up releasing some sort of big news, there's a lot more investor interest and it drives the stock price up later on. However, when a company IPOs on the TSX, they're usually not as well known by the public, but once they've been on the market for a little bit and there's more articles written about it, then a lot more investors are aware of the stock and are watching it. And right now with Canadian technology, I think that it's in its infancy, just like the US about 10 to 15 years ago. The S&P 500 used to not be as heavily dominated by technology stocks, just like the TSX is right now. Roughly 10% of the TSX is made up of technology stocks, versus the S&P 500, 25% of that is made up of technology. So I think Canada right now is in the early stage of a technology boom, and we see a lot more SaaS companies IPOing on the TSX. So Dye & Durham is one of these, and I think they have a great business going forward that could eventually see major stock price appreciation. And with the boom of technology stocks in Canada, what this means is there's a lot more talent that's going to be attracted to Canadian companies, and we're going to see the quality of talent or software developers increase. And as the talent and quality of software developers increase, this is only going to drive businesses further in their product development and ultimately drive profits. Now talking a bit about what Dye & Durham's business is. So what they are is a leading provider of cloud-based software and technology solutions designed to improve efficiency and increase productivity for legal and business professionals. So that's quite a bit of a handful right there, but essentially they're making SaaS software for legal and business professionals. Currently, they operate within Canada as well as the United Kingdom, and yet have penetrated the United States. They actually showed their market size in Canada, United Kingdom versus the United States in their final prospectus before they IPO'd. And I'll throw that chart right up on the screen right now. And you can see that the United States makes up roughly a total addressable market of $9.4 billion, versus Canada and United Kingdom sit somewhere around $1 billion each. So United States is roughly 9 times larger of a market than Canada or United Kingdom. And once Dye & Durham announces that they're expanding into the USA, I think we could see some big stock price appreciation because this is going to take their business to the next level. And they have strong blue chip companies as their customers. In fact, they have over 25,000 customers and their churn rate is only 2%. If we drill down deeper into who their customers are, you can think of their customers as law firms, governments, as well as financial service institutions. Now, if we look at the charts a bit, they IPO'd on July 17th, as I mentioned before, and they IPO'd at a stock price of $7.50. However, you're not going to get that stock on the first day for $7.50 because that's what the underwriters paid for it. Dye & Durham did pretty well itself, and the stock popped about 200% on the first day. And today the stock trades somewhere around $24 depending on when you're watching this, and that roughly means another 70 to 80% stock price appreciation from the first day. However, if we look at other stocks like Docebo, the first day that they IPO'd, their stock was at $16, and today it sits somewhere at around $50 per share. So we saw at least a 150% increase in that stock, whereas Dye & Durham is only a 70% increase since the first day. If we look at the market cap of Dye & Durham, they sit at somewhere around $1.09 billion as of filming today, and they have a total addressable market of $12.5 billion for their current software. That doesn't mean that this company is only pigeonholed into this $12.5 billion market, which is already large in itself for the company's size, but it means that this is their current total addressable market. And as the company continues to expand their product offering, I'm sure they're going to expand into different verticals, which will allow them to increase their business opportunities in the future. So typically how software companies work, at least what I've seen on the market, is that they focus on one single vertical, and when they build up their software within that vertical, then they're able to use some of the universal components from that first vertical and switch it over into another vertical. So things like billing, time tracking, or customer relation management, these things are universal across all businesses. So they can take these software modules from the first vertical and just port them over to the second vertical, and there's less development to develop a new product for a new vertical. So that's the power of software, and that's why I'm so excited about this company that's still growing at a very rapid rate. If we take a look at the revenues for the past 9 months as of March 31st, versus last year's revenues as of March 31st, we can see that they increased their revenues by 60%. Typically, growth companies, we see their revenues increase somewhere around 50 to even 200%, depending on how large they are. But right now, I don't really have a good grasp on how sustainable the 60% number is in terms of growth, because they haven't released that much financial information, and they're still in the early days of the business. I'm currently waiting for a few quarters to pass before I make some sort of projection on what their growth looks like in the following 5 years. But seeing as the revenue is only about $60,000 for 9 months, and if we extrapolate that out to a full year, we can expect $80 million in this year. And if we compare $80 million to the total addressable market within Canada and UK at $2 billion, that's a very small portion of the market. And especially if they expanded to the United States, $80 million versus $12.5 billion, there's a huge difference there, which means Dye & Durham is still a small player in this market and has a lot more market share that they can capture. And I think law firms right now are still in the early days of adopting technology, and that's why I'm looking for more entry points in Dye & Durham for the month of September. If we take a look at the financials just to get an idea of the financial health of this company, the company currently has a current ratio as of filing the prospectus on March 31st of less than 1. And typically, I look at this and see this as a dangerous sign because they don't have enough short-term assets to cover the short-term liabilities. However, this prospectus was filed before their IPO, which they raised $150 million, which puts their current ratio right now, if we add that in, at 6.5. So this is more than enough cash to cover the short-term liabilities, but as Dye & Durham is a growing company, we know that they're going to use this money quickly for mergers and acquisitions. And to date, they've already merged and acquired about 13 different companies, so I expect them to do more mergers and acquisitions in the coming year to be able to accelerate the business growth. On the revenue side, in the current fiscal year, I believe they can make somewhere around $80 million in this year. However, the company is still not profitable and they're generating a loss every single quarter. As of 9 months, March 31st, they had a total loss of $7.5 million, but that's not a huge amount for a $1 billion company, and they raised $150 million, which is more than enough to cover that $7 million loss. If you guys have never heard of Dye & Durham, let me know in the comments down below so I know how many of you guys have never heard of it in the YouTube community. Before we move on, I'd appreciate an early thumbs up, and that would be awesome if you could do that right now. So the next stock we have is TELUS. TELUS is traded in both Canadian and American markets, so if you're an American watching this video, you can also purchase TELUS. And for those of you guys who live in Canada, you know that there are 3 major carriers: TELUS, Rogers, and Bell. And here are the few reasons as to why I chose TELUS over Bell and Rogers. If we take a look at the balance sheets of these 3 companies, they're roughly on par based on their market cap. So Bell, although they have more cash and more liabilities, they are twice the size of Rogers and TELUS. But if we dig a little bit deeper in terms of the growth of these companies, TELUS is the only company that analysts predict to have growth this year as well as next year. Versus Rogers and Bell, both of them are expected to have declines in revenue in this year, and their growth next year is minimal. These 3 telecom companies in Canada currently have a monopoly, and the reason is it's very expensive to get into telecom. There's a lot of infrastructure, especially for Canada being such a large country. You have to put in the capital to be able to build up all those telephone lines, those fiber networks, as well as all the different retail stores to get your brand out there. So this takes billions of dollars, and that's why we see the liabilities on these companies' balance sheets to be extremely high. There are smaller companies that are trying to get off into the space. However, they're a little bit more established companies than a natural startup. Companies like Shaw Communications are coming into the market right now trying to steal away market share from these big 3 companies. So pay attention to Shaw if you're looking more for a growth company in the telecom space. However, there's significant risk because they have to spend massive marketing dollars to acquire customers from these big 3 telecom companies. Another reason I chose TELUS is because of their customer service. Looking online for a few minutes, people are always railing on Rogers and Bell for having poor customer service, whereas TELUS, they have amazing customer service. Also, employees at TELUS report that TELUS treats their employees very well, Versus Rogers and Bell, their employee satisfaction is quite low. So TELUS having a better customer satisfaction as well as employee satisfaction will ultimately lead to larger market share for TELUS in the long run. Because if you can't keep your top talent as well as your best customers, then your business is ultimately going to fail and the competition is going to steal away your customers. If we look at the dividends of all three of these companies, currently Rogers pays the lowest dividend, Bell pays the highest dividend, and TELUS is somewhere in the middle. However, TELUS has a track record of growing the dividends quicker than Rogers and Bell. Rogers has been increasing the dividend at a rate of 1.4% in the past 5 years and 5.4% in the past 10 years. Bell has been growing the dividend at 5.1% in the past 5 years and 6.1% in the past 10 years. And TELUS has been growing the dividend in the past 5 years at 8%, and the past 10 years, 9.6%. Although TELUS is in the middle of the pack for dividends, I believe in the long run they're going to have a larger dividend than Bell. Another thing about TELUS is that they have the best discount brand, which is Public Mobile, versus Rogers Chatter and Bell's Lucky Mobile. So all three of these discount carriers have roughly similar pricing. However, what separates Public Mobile from the other three is that they have ways that you can earn monthly discounts towards your bill. So for example, if you do auto pay, which everybody should be doing auto pay, you get $2 off instantly. So if you're purchasing a $15 plan, instantly it becomes $13 if you do auto pay. On Chatter and Lucky Mobile, you're still at $15 even though you're doing auto pay. On top of that, every year that you're with Public Mobile, you save $1 off your bill, up to a maximum of $5. So if you do auto pay and you're with Public Mobile for $5 and you have a $15 plan, you're paying around $8 per month. If you're interested in signing up for Public Mobile, check out the link down below and use my referral code as you get $10 in credit when you sign up today. If you're wondering how Public Mobile can be profitable for TELUS, it's because they're using older infrastructure to support these cell phone plans. So a lot of their plans use 3G, which is older hardware, and TELUS is able to make use of their older infrastructure that they've installed years ago. And for users like me, 3G is perfectly fine to watch YouTube videos. And Public Mobile has very limited customer service, and they're able to pass off these cost savings to their customers. If you don't really care about service like me, you can do most things on your account online, about 95% of it, without needing to contact customer support. So I prefer cheaper prices than quality customer support, and I'm willing to sacrifice that if I can save a lot of money. One other thing about TELUS is that they're not only in the communication space, they're also venturing out into health tech space with their EMR platform, which I've discussed on my previous video on Well Health Technologies. So TELUS is creating an electronic medical record system that allows doctors to record patient data on the cloud, instead of doing the traditional method of pen and paper. And this market is largely untapped, and TELUS is going into that space, and they're not going to stop there at the electronic medical records. I'm sure they're going to venture out into other SaaS businesses, and this is only going to increase the margins of their business as a whole. So I think TELUS is more exciting than Rogers and Bell if you're looking for a solid telecom company. The last stock that we have here is Waste Connections. Waste Connections is not only traded on the Canadian Stock Exchange, they're also traded on the New York Stock Exchange. And I've briefly mentioned this and shown this in my portfolio on WealthSimple Trade. The reason why I'm looking at Waste Connections in the following month is because looking at the stock chart for Waste Connections, they've been consolidating for the past year. The stock price, if you look at a year ago, it was roughly around the 130 level, and today we're still sitting around the 130 level. But within this year time frame, Waste Connections is still continuing to grow their business. Although their last quarter, if you looked at it, they had negative net income, which is unusual for this company, but that's due to a one-time charge of E&P waste disposal. And that charge was $417 million versus the net income or net loss of negative $220 million approximately. If we remove that one-time charge, the quarter would have been a profitable quarter, just like the previous quarters. And right now, you can look at the P ratio history on Wolfram Alpha. You can see that the P ratio is sitting around a 30 to 40. However, with the recent quarters, it shot up to 128. So I think the P ratio for Waste Connections is definitely not representative of how the business is going to operate going forwards. And how Waste Connections is growing their business is through mergers and acquisitions. If we look at the whole trash segment, there's still a lot of individual trash companies that are managing recycling and garbage. And Waste Connections is going out there, finding the best companies and purchasing them for a premium. And although they're paying a little bit more than what the business is worth, Ultimately, they're able to merge that business with theirs and bring more efficiencies into that and increase the profitability of that business long term. So the premium that they pay now, they're able to recuperate that in cost savings, as well as able to continue to grow their business and capture more market share. And if we look at the total addressable market for trash, it is anywhere from $450 billion to $2.3 trillion in the next 10 years. And that is a huge range, I know, but nonetheless, looking at this, whether it's $400 billion versus $2 trillion, it's still a massive market opportunity that Waste Connections is able to go and tackle. And currently, with their revenues each year at around $5 billion, they have just penetrated about 1% of the total market. So Waste Connections still has a lot of room to grow. If we look at the current ratio for Waste Connections, it's sitting around 1.5. This shows that management is not keeping too much cash around, just lying around, and they're deploying that cash in order to generate more revenue. And primarily this is through mergers and acquisitions and their regular operating costs. If we're looking at the cash flow statement, every single year for the past 4 years, they've had a positive cash flow, which means this company is generating more cash than they're putting out. And what's more important about the cash flow statement here is that they're not generating cash by raising capital. So if we look at the past 4 years, they haven't done any sort of significant equity raise. The capital generated from common stocks issued is generated from issuing shares to internal stakeholders, such as the C-suite team as well as employees. And my final point for Waste Connections is if we look at how society runs and how much trash we generate, it's just increasing. Especially with COVID-19 and how everyone's doing online shopping, the recycling and trash opportunities are going to become massive. Because with all the boxes and packaging material that's being shipped out these days, this is all ending up in landfills or within the recycling plants. So Waste Connections is only going to capture on this trend of people doing more online shopping, as COVID has helped break down the barrier of people needing to see the products in person before purchasing. Also, shipping has become more convenient and returns are a lot more easier, such that people are more comfortable buying online today and ultimately generating more waste for Waste Connections. So going forward, I only see this company continuing to grow, and right now, because the stock has consolidated for a year, I expect a breakout to happen in the next year or so, depending on how long this consolidation period is. But know that the business was still growing in this past year, and that essentially right now, if you're getting into the stock, you're getting in at the same price 1 year ago when the business was smaller. And that's why I'm looking for entry points in the month of September. Smash the like button if you got any value out of this video and learned something new about Canadian stocks. Hit that subscribe button and the notification bell if you're interested in learning more about stocks and how I analyze companies. Keep up the grind and have a great day.